You are listening to the ESG and Coffee Podcast on investing, strategy, and sustainability, hosted by Graham Sinclair.
Yeah, I mean, simplistically, I think it's the prioritization of non-financial factors such as ESG into the investment process. And I ultimately believe there's a direct link between doing right by the environment, your employees, your community, and your shareholders. Essentially, our goal is to make the oil and gas industry more investable and more sustainable in the face of the energy transition. And ESG factors are a critical component of that equation. So I really like the movie Moneyball. I'm a Michael Lewis fan.
Are you a baseball guy?
I always played basketball. You can't tell from the screen, but I'm 6'6", so I was kind of naturally inclined to play basketball growing up. But I thought the book translated well into a movie. But I just love the scene where you have these old school scouts sitting around the conference table talking about the different players, and they're saying ridiculous things like, well, this guy has a great jawline, or he looks like a ball player, or they start talking about his girlfriend and what it means for his confidence. And to me, it's basically what the investment management industry was for so long.
I'm pleased to welcome in episode 9 of the first season of ESG and Coffee Podcast, Mark Viviano, Managing Partner and Lead Portfolio Manager, Public Equities at Kimmeridge Energy. He is one of the originals. His bio reads, quote, Managing Partner and Lead Portfolio Manager on the Public Investment Team, and prior to joining Kimmeridge, Mr. Viviano spent 17 years at Wellington Management Company, unquote. I first met Mark watching him speak eloquently in a session on expectations for the hydrocarbon sector, the role of investors, starting with holding management accountable for earning their compensation. It was hosted by The Deal in their shareholder activism event in February of 2021, and I spotted him when I was curating speakers for the Greenfin 21 event we hosted last April. In the session on Spotlight interview, Restoring Investor Confidence in the Energy and Power Sector, Mark was the first investment practitioner I'd met in a long while investing in that sector, holding this powerful oil and gas industry to account for simple items like stopping planned flaring, burning and polluting as an ordinary part of the chemical engineering manufacturing process. It's that frustrating thing where you can see a refinery, whether you drive from New York to Philadelphia or outside of Cape Town or anywhere around the world, where you can see that orange glow above the steel pipes of the refinery, and just as part of the process on any ordinary day, they're burning that gas, which is just creating more pollution and frankly wasting money. Kimmeridge itself is a private equity firm based in New York and Denver. So this interview is a bit different. It's someone who's dealing directly in his sights as the oil and gas industry, which, if you recall in episode 3, Garvin J. Bush was very clear that he would never have any investments in that sector. Not declaring my own position until the end, where I pull through some highlights. Listen to the interview and then and some of the highlights later to assess the quality of Mark's ideas and how he's going about executing them. So here's Mark Viviano in our next episode. And as always, a reminder, this is not investment advice. Enjoy. I'm delighted to have with me Mark Viviano. He's Managing Partner and Lead Portfolio Manager on the Public Investment Team at Kimmeridge. And he's going to explain to us in a few moments more about that. As always, we have detail in the show notes and so many hyperlinks. And Mark's done a great job of doing podcasts and preparing white papers, all of which I've plowed through. And there's a lot of material for us to cover in today's interview. A caveat, as always, this podcast is not investment marketing or selling. We're here to learn. We're here to explain. We're here to look at investment decisions through the eyes of an ESG architect. So first of all, welcome, Mark Viviano.
Thanks, Graham. Pleasure to be here with you today.
Excellent. And where in the world are you today, sir?
So I'm currently in Boston, Massachusetts. I'm sitting in an office that I opened for Kimmeridge last year, and it's downtown Boston in the financial district.
Excellent. I always remember summer afternoons in Boston were pretty sweet. If you're downtown and everyone kind of clears out, go down by Fort Point Channel there or something. There's some nice spots, yeah?
Important to remember when you're going through 3 months of winter.
Yes, exactly. The one thing I learned living in Boston for the first time and the second time was enjoy the summers because winter is coming, right? And how are you feeling today? Let me check in, of course, mental health, much more important. Happy to talk about it. But how are you doing? How's your family? We're living through a pandemic. Like, how are you doing?
Yeah, I'm doing well, thanks. I mean, this past year has been challenging for everyone, but I feel fortunate. Our kids have been healthy and generally happy. So yeah, family's well, and looking forward to the conversation today.
Excellent. Well, thank you so much for joining us. Starting as ESG and coffee, first question. Today I'm enjoying an iced coffee. If we're at your local, what would I be ordering for you from the barista?
Yeah, so there's a great coffee spot that opened up right behind my building early last year. It's called the Tradesman. I've got my coffee right here, and they've benefited from the city allowing outdoor tables on the street. So it's got this European cafe vibe, which I'm sure you'll remember was always missing from downtown Boston. And they brew this coffee called Barrington Coffee, which most of your listeners probably aren't familiar with. It's been around forever. It actually founded back in '93. It's a roastery out in the Berkshires, so the western part of Massachusetts, and really great coffee. And it's a place where I end up meeting people these days. But my drink of choice is a cappuccino with almond milk, which, like I said, I've got here in front of me to make this as authentic as possible.
Oh, fantastic. Well, shout out to the Tradesman in downtown Boston and Barrington Coffee Roasters out in the Berkshires. So first of all, a curiosity, as always, I search what I can on my guests. And I found on LinkedIn, you had liked a comment, really interesting. The Bumble CEO, Whitney Wolfe heard, she wrote about being a fantastic, it was described she was being a fantastic role model for all founders, male or female. There was a Wall Street Journal story where the CEO had criticized the treatment of female business founders. What does this story resonate with you?
Well, yeah, I mean, I'm sure through your surveillance, you notice I'm not that active social media, particularly on LinkedIn, but that commentary that was provided on the Wall Street Journal article you referenced, it really resonated with me. And I mean, it was basically making 2 points. One, women are exceptional founders and we need more of them. And then two, we all need to do a better job of not holding different genders to different standards. And it's really that second point that struck a chord with me. I mean, I personally live in a house of all girls. I've got 2 daughters. And like most parents, my goal is to convince them they're capable of doing anything in life. And I never want them to think their ambitions should be inhibited by their gender. So I'm just supportive of anything we can do to level the playing field and break down the barriers of success for women. And that starts with not having different standards for behavior. So that's why I liked it, and that's why it resonated.
Yeah, excellent. And I think we'll pick up on some of that theme when we talk later around governance and diversity on boards in the sector. Right, I like to start at the beginning with a big picture idea with my interviews, and we look at the tragedy of the horizons. The classic phrase used by Mark Carney in 2015 when he gave a seminal speech at Lloyd's of London talking about how the financial sector needs to take climate seriously. And by looking back, I was struck by Sir David Attenborough's Netflix documentary. You know, he's 90-something now. You know, we enjoy every day we still have him on the planet. He put out a documentary called Our Planet. I don't know if you have seen it on Netflix.
I have, although I have to tell you, I had to fast forward some of the parts because my wife wasn't a big fan of watching polar bears eat baby seals. But yeah, no, it was a great documentary.
We have had one of those because, you know, it would be after dinner, sitting at the table there. Do you want to watch something? And we have had one of those when the lion gnaws into the wildebeest carcass. Yeah, we've survived one of those incidents. In the documentary, Sir David talks about 2 data points that really struck me when you even look at the span of his life or his working life. So we've incorporated them here in ESG and Coffee podcast. So the question for you, my guest, is in the year you earned your first career paycheck, which you don't have to tell us, you can if you want to. What is your answer to each of these data points? I'm going to ask you, you're going to answer, and then we've got a bonus data point. So world population. In your first professional year, what was it roughly?
So my first professional year was 1999, and I still remember I made $26,000 that year. It was a operations role, but I was just happy to have a job out of college. And yeah, the world population, I looked it up, was 6 billion at that point.
Okay. And today it's around 7.882 billion. Right. S&P 500.
Yes, shockingly, 1,300 at the time in 1999.
It's just, until you look at these numbers, you don't really believe them, right? So now it's around 4,290, say 4,300. And then carbon dioxide in parts per million.
368, 1999.
Oof, just over that magic 350 number, but still close. Today, 415 parts per million. And then the bonus number, because you work in a commodities space and we have numbers. So the price of a barrel of oil and I guess it's a gallon of gasoline in the US, yeah?
Yeah. So oil back then was $23 a barrel, if you can believe that, and gasoline was just a little over $1. I think the average annual retail price that year was $1.02, and today that'd be, I mean, I'm sure you have the answer, but it's over $3, I believe.
Yeah, it's $72 a barrel roughly this week, and then price of gasoline right now, it's summer season, so it's always trending up, right? But right now, on average, just over $3.13. So how does it feel to look across those numbers and reflect on your time as a professional?
Yeah, I mean, when we think about the first three numbers we talked about, so before the commodity prices, the first thing that pops in my head is just the power of compounding. And it was Albert Einstein who always was famous for saying compound interest is the eighth wonder of the world. And obviously we're not talking about compound financial interest here, but it's a basic idea of big numbers getting bigger over time. And the power of compounding can be great from a financial perspective, but it's obviously a challenge as when it comes to the environment and the impact our society is having on this planet.
Yeah. All right, let's jump over to our first set of espresso shot questions. Are you ready?
Yep, I'm ready.
Here we go. What is your earliest memory of investing?
So I started investing back in 1999. So after I graduated from college and had that first job, and I had no idea what I was doing. I was just following CNBC or whatever the hot tech tip of the day was, the high flying tech name.
And there was no Robin Hood, so how were you doing it?
I actually had to call up. I had a broker at Smith Barney. I had to literally pick up a phone and call. And you think how different that is today than the millennials that have access to an app. And I mean, to me, that's somewhat dangerous, but we'll save that for a different discussion. But I would just, the punchline of the story is I ended up losing half my money. But along the way, just learned some valuable lessons on the difference between speculation and investing. And if anything, it motivated me to really learn the craft of investing and understand the intricacies of it.
Excellent. Second question. What is your philosophy of investing, but in one sentence?
I just say highest quality assets for the lowest price. And that might seem overly simplistic, but I actually think the entire art of investing lies in the compromise between those two variables, between price and quality.
That's how I choose my bananas too. What switched you on to ESG?
Yeah, so I mean, I think we'll get into my background here, but I had spent my career at Wellington Management, and I just I had a front row seat to seeing how ESG was being integrated into the investment process. And this was years ago, 3, 4, 5 years ago, well ahead of it getting the mainstream attention it's getting today. And I could just see how unprepared the oil and gas sector, which was my focus, was for the train that was coming down the tracks. And that really just kind of switched me on to this is going to be big, and this sector is unprepared for it.
I got a personal connection back to Wellington, which I'll drop in a little bit. How do you choose to define sustainable investment or investing with ESG factors in less than 30 words?
Less than 30. Okay. Sustainable investing at its core it's fundamentally a form of risk management. It's important to understand how non-financial factors, which are largely captured in ESG, are going to affect the risk profile of any investment.
We'll
Hopefully
do
that's
the
less than
count check
30.
later. Yeah. And finally, for our first set of espresso shot question, what is your biggest investing mistake so far? We all have them. What do you want to tell us?
Well, I think most people would probably say staying in oil and gas investing for 17 years. Not only did I not switch sectors when I was at a large firm like Wellington, but I went in all in by joining a firm that only invests in oil and gas. So we'll see on that one. The book hasn't been written and time will tell, but I think that's one that most people would point to.
Great. And I have appreciated researching and hearing you describe your work, how you made that decision. So I do want to pick that up, your kind of career decisions. Okay, deep dive one then. Here we go. We start by looking a bit at the firm and your strategy, some of the themes, before we move to deep dive 2 and 3. So first up, just the basics. What does your job title mean? Managing partner and lead portfolio manager on the public investment team at Kimmeridge Energy. What does that title mean?
Yeah, it's funny because when I was in discussions to join Kimmeridge, the title never came up once. It's something I didn't really care that much about at this stage in my career. So I learned of my title when the business cards showed up at the office. But like effectively, I joined Kimmeridge to launch a strategy focused on reforming the public oil and gas sector. And so what it means is I head up a team as the portfolio manager, ultimately making the investment decisions.
Okay, got it. And if we have a variety of listeners, right? Some are picture a pension fund trustee, picture a wealth manager, picture a new ESG person, picture an old ESG person at an investment shop. So 4 quick dimensions. So I like to situate you in the investment value chain. So what is your role and what are the roles that your firm serves? If I had to give you the simplified value chain here, owns the money, gathers the assets, does the investment research, makes the investment decision, influences the investment ecosystem. What is your role in that chain?
Yeah, we take on all those roles except the original role of having the money. So we're not the allocator. We invest other people's money. Institutional money. But when we have that money, we're doing the fundamental bottom-up research on the oil and gas sector. We're making investments in the sector, and then we're trying to influence those investments through engagement and ultimately activism.
And give me 60 seconds just on, I've heard you describe in other interviews. Now, these happened a couple of months ago, so I don't know where you are today. But you described you were raising a fund. So I don't know if compliance lets you talk about it now, but can you give us a quick context?
Yeah, what I can say is we launched a standalone strategy April of 2020 that was focused on reforming the oil and gas sector through making public investments and looking, like I said, through the lens of engagement and activism. So I can't get into the specifics of the fund, but it is a standalone strategy that I had as the lead portfolio manager that we launched last year.
Okay, and is that open? Is it closed? Are you still gathering assets or?
It's still we're still in the fundraising period for the strategy.
Okay, got it. And happy to drop whatever you want into the show notes later for people who are curious. Yeah. So I like to also kind of start and to be as inclusive as I can. And in this case, I have a 10-year-old. And I have to explain to him what I'm doing. So he knows what a podcast is now, right? He knows how to stay quiet. But how would you explain what you do to my 10-year-old child?
Well, that's easy for me because I have a 9-year-old, and she asks me the question, how do I make money? And so the way I've explained it to her is, people give me $10, and my job is to give them back 20. And if I give them back 20, I get to keep 1 or 2 of it. And she doesn't know much more beyond that, except that it has something to do with oil, which is great when you live in Massachusetts. And she tells her friends I work in oil because I'm pretty sure most of them think I work at a gas station or something.
Yeah, that's pretty real. My father-in-law used to work at a gas station somewhere in Western Pennsylvania. He has stories.
Can imagine.
Right. Next question. What are you teaching your colleagues or your first-year analysts about making the sustainable investment case? How have you explained that to either people you're hiring in or colleagues who go, but what exactly are you doing here, Mark?
Yeah, I mean, simplistically, I think it's the prioritization of non-financial factors such as ESG into the investment process. And I ultimately believe there's a direct link between doing right by the environment, your employees, your community, and your shareholders. Essentially, our goal is to make the oil and gas industry more investable and more sustainable in the face of the energy transition, and ESG factors are a critical component of that equation.
Thank you. So moving on now to kind of the shape of the investment business and the increasing demand for investment strategies that are proactively including environment, social, and governance factors. I just saw something again this morning from Axios on asset owners. Actually, they thought they had this covered. They're actually going to increase their activity. We're tracking that. Of course, more asset owners are looking at this, but now the pace of interest is increasing. I want to quote back to you a phrase you used in an interview with an investment bank. I think it was end of last year, second half of last year. It says, I continue to believe that the momentum around ESG investing represents an existential crisis to the public energy sector, particularly when you think about the E, environment. And the increased focus on the environmental component of ESG is related to the growing risks around climate change. Those risks are bucketed in two categories: the physical asset risk, and the second is a transition risk. We're going to unpack this in many ways across the interview, but could you just deal with this question of, and even I think it came up with the interview with the Houston lawyers, this question of what do investors want, and is this demand increasing or decreasing? What are you seeing?
Yeah, so I think investors increasingly want to understand how their investments are aligned with the energy transition. And that has to do with a number of different factors. Like I said, a lot of it has to do with risk. I mean, you don't want to own assets that you think are going to lose value over time as we decarbonize the world. And oil and gas is at the top of that list. And so it's about making sure that these companies are prepared for the energy transition to allow them to be viable investments within portfolios. And as you know, increasingly, people are looking to divest of fossil fuel assets for that very reason. So it's about trying to reform this sector to make sure that these companies are investable.
Okay. And stepping on then to the business of investment, just the basics. How does one buy your investment service? Can you buy it in a 401k plan? Who's investing in you and how do they buy you?
Yeah, so all of our business is institutional. So it would be pensions, endowments, foundations, sovereign wealth funds. So there is no direct retail channel, and depending on the characteristics of your listener base, it'd probably be hard for most people to directly invest in what we're doing.
Okay, unless you do engine number one and roll out your ETF, right?
Yeah, that was fascinating to see, but no plans on the drawing board as of
yeah. So I'm actually going to speak of kids. I'm actually going to, as part of kind of teaching the kid what I do, we're going to, a nominal amount of money. We're privileged enough to put a nominal amount of money into that ETF at 5 basis points, tracks the S&P 500, claims to be activist. And that's going to be part of his worked example that we're going to track and see what happens. And then I've been considering this problem of pricing and pricing of investment services. And I've done due diligence on a huge range of typically ESG strategies, what have you, and the pricing really varies. So again, very simple question. How do you price your investment service? How do you earn that $1 to $2 that you told your daughter about?
Yeah, so I'm not going to get into the specific dynamics of the business, but I would just say that, listen, the fee structure is ultimately determined by market forces. I'd say it's generally aligned with the way other activist strategies think about fee structure. I think what is differentiated about the way we've set things up is just the alignment in our business. And essentially, we don't make money unless our investors are making money, which is, I think, critical to having a sustainable business in the investment management industry.
Okay, great. And now let's drill down into your actual fund strategy. Yeah. So, I'm keen to hear, as much as you want to share with us in terms of, did the idea come to you when you're out on a run? Did you in the shower? Where did the idea come from? And then unpack for us, take a couple of minutes on what is the big strategy idea and how are you looking to execute it?
Yeah, no, I'll step back and just kind of give a little background on the decision to leave Wellington and join Kimmeridge, because I think that has a lot to do with the formation of the strategy. But generally 3 to 4 years ago when I was at Wellington, I was just getting increasingly frustrated that the public energy sector was uninvestable. And I've talked about this, but originally it was the flawed capital allocation, misalignment of incentives, things that are well appreciated at this point, but increasingly it was these risks associated with the energy transition. And I would have portfolio managers come to me and say, I think oil's going away in 10 years. Why would I bother owning an energy stock, right? That's that existential risk you were talking about. And I didn't think the industry had a good response to that question, especially as they just continue to invest all their cash flow back into ground to grow production. And they had this terrible ESG profile. So I was at a crossroads where I either needed to abandon the sector or find a way to help fix it. And obviously at Wellington, we were engaging with the CEOs and the boards of these companies as large shareholders, but it became clear to me that any progress we were making around reforming the business model was just far too slow and incremental for the crisis that was at hand. And so what I also saw when I was at Wellington was that as soon as an activist was involved in a particular company, there was this heightened degree of engagement with shareholders, especially at the board level, and this acceleration of change. So I knew that was what the sector needed. It's just Wellington wasn't set up culturally or organizationally for activism. So the attraction to joining Kimmeridge was that they had already established a platform for activism. Despite being a private equity firm, traditionally, they had identified the value opportunity in the public markets in the oil and gas sector, but also recognized that you needed to push for reform if you wanted to unlock any of that value. So they had embarked on a few campaigns prior to me joining. And so I started having the conversation with them in late 2019, which was basically, I need the right platform for activism, and you want to do more on the activist side. And that's really how it came together. And then we separated out and launched it as a standalone strategy.
Okay. And if you can, again, as much as you're allowed to say, that your strategy is, so it's an activist strategy and your focus is on listed markets. I've also heard you talk about the US sector. So are you US specific or are you global?
Yep. So the initial strategy we launched was singularly focused on the US upstream oil and gas sector. So essentially the US shale industry.
Okay.
That was my background. That was the specialty of the firm on the private side. And so it was really about sticking in with our circle of competence and an initial focus on the US upstream oil and gas sector.
Okay. And then the approach that you take, so there's X number, I don't know, you can tell me how many listed entities are in this possible universe. And then you have a look at them, you take a view, you've been doing it, for 2 decades nearly. And you say, well, this is going to be the best target for us to work at. The deepest dive I've had on this is tracking what Engine One did around ExxonMobil. It was very public. I looked at their 50-slide deck that they pitched to various institutional investors to get them on board, which helped move them forward. How do you kind of decide on which companies you're going to work with? I know you're limited on what you can speak about in terms of legal and compliance, but just give us the basics of how does this strategy get executed?
Yeah, so I mean, what I can say is that universe is call it 40 to 50 names if you think about the U.S. listed upstream oil and gas sector, and the strategy that I manage has publicly filed on 4 names, and so it's a highly concentrated approach with a very diligent screening process and really high grading the opportunity set, and I think what differentiates us from most strategies is that in a lot of ways, we're looking at companies that are laggards on some of these issues in ESG, because what we're looking for is vulnerability to activism. The one area we won't sacrifice on is asset quality. And at the end of the day, this is a commodity business that is driven by geology. And you can change a lot in a company. You can change the board, you can change the compensation structure, you can change their ESG performance. You can't change the rocks. And so we start with understanding the difference in asset quality across the landscape. And then ultimately, we're looking for companies where we think there is an opportunity to make money by repositioning them for the energy transition. And that means evolving the operating model, the governance, and the environmental performance. And we think if we can reposition companies successfully to attract a better shareholder base and garner a higher multiple or higher valuation, it's going to be beneficial to our investors.
And thank you. And I've heard you speak about to a more specialist audience. Appreciate we have a more generous audience, on this podcast, but you spoke a bit about what happened in, I think 2016 was the last kind of stressful period for the sector, and where the money did and did not go. And then fast forward to 2021. You had an interview in 2020, I think right after the darkest days for the oil sector before the Saudis kind of told everyone to get in line, and we are where we are now in summer of 2021. Could you just unpack a little bit for us, kind of what you've seen play out, for the last part of the last decade, and bring us up to date?
Yeah, the simplest way to think about it has just been a decade of value destruction in the sector. I mean, oil and gas has been the worst performing sector, and investors have generally abandoned it. And I think for too long, the CEOs of these companies have thought it's cyclical, that it's just a matter of tracking the volatility in the commodity price, and then ultimately at higher commodity prices, those investors will return, because that's historically been the pattern in the sector. I think the most eye-opening experience for me and most of the investment community was a year like 2019, where oil prices were generally healthy, called $60 or so, not at the levels we're at today. But the sector continued to underperform, and the companies continued to derate from a valuation multiple perspective. And I think it has so much to do with the issues that we're talking about today and the risks associated with the energy transition. So when I joined Kimmeridge in February of 2020, we put out our initial white paper, and it was called Preparing the E&P Sector for the Energy Transition. And it was about the need to reform the business model, which is about lowering the reinvestment rate, increasing the return of capital to investors to compensate for that growing risk around the uncertainty of long-term demand growth. It's about improving the environmental performance of the industry, moving to a net zero position, and then ultimately reforming the governance so that there's greater alignment and accountability. And our view has been, until you address all those issues, investors aren't coming back to the sector, regardless of what the oil price is.
Yeah, and to reinforce that fact, we in episode 3 we had an interview with Garvin J. Bush. He's a specialist green alpha advisors, and he has not been in fossil fuels since 2002. It's just a view he's taken, and he's looking for growth and performance in his mandate elsewhere. So absolutely. I think I also heard you describe something about the revenues and what the businesses were doing with those revenues. And you gave a worked example of you were in a meeting at Wellington or some investment manager, and sitting across the table from a CEO of an oil and gas E&P company, and they were saying, well, we're going to put 100% into X, not Y, and you were trying to explain, like, that doesn't fly. Could you explain that better than I have?
Yeah, no, sure. I mean, the simple way to think about it is, over the past decade, if you just look at the U.S. upstream oil and gas sector, they've, on average, reinvested 130% of their cash flow, which means for every dollar that comes in from selling their oil and gas after their expenses, they would put $1.30 back into the ground from a capital investment standpoint. I think we can all sit here and say, I'm sure your 10-year-old would appreciate the fact that that is not a sustainable business model, right? It's relying on external capital, which we all know is no longer available to this industry. And so we and other large investors, we're pushing back on this model, saying it's not sustainable. You need to reduce your reinvestment rate. And the industry came back in 2018, 2019, and started talking about this mantra of capital discipline. But their definition of capital discipline was moving that 130% down to 100%. So every dollar that comes in would still go out. Again, not a sustainable business model. And what I tried to point out to them is that the average S&P company, so across all sectors, reinvests 40% of their cash flow. So every dollar that comes in, 40 cents goes out, 60 cents can be used for things like return of capital to investors. And so these companies would come into our office. The CEO of these oil companies would come to Wellington, and they would sit at in these conference rooms, and you would have generalist portfolio managers that were investing in technology and healthcare and retail and all these sectors that were performing much better. And they would say with a straight face to the portfolio managers, we're capital disciplined. We only invest 100% of our cash flow. And I mean, they literally get laughed out of the room. And then the portfolio manager would just stop coming to the meetings, which actually isn't helpful, because then they're no longer even getting that feedback, which I think you're
not even in the selection pipeline.
You're not even in the discussion. Yeah. And that was, increasingly what concerned me about this idea that the sector was uninvestable. The utter lack of engagement from a portfolio management perspective. And so when we came out with that white paper in February of last year, the first thing we did is say the industry needs to bring its reinvestment rate down below 70%. And it's never going to be 40% like the rest of the market, because it is a capital intensive industry. I mean, there is an underlying decline rate, as you know, and you have to reinvest in your production. But the idea of having that above 70% is a non-starter if you want to attract any investors back to this thing.
So the concept of the reinvestment rate and like how long you do it. I mean, for me, this is kind of fascinating watching in our careers, in our lifetime, we're watching an energy shift, right? I mean, we can say the words transition, just transition, rapid, how rapid, but it's amazing. It's significant, right? I drove past the elementary school the other day and there was no electric cars in that parking lot. In the UK, in less than a decade, in Norway, in 3 years, every car, if it's new, every car would be an EV. I mean, that's amazing, right? So let me transition to Javier Blas at Bloomberg had this great long read where he's interviewed the Saudi oil minister who was speaking about the use of his power, particularly last year. They intervened, and there's all stuff I don't want to really cover in our interview. We can cover on the ESG and Whiskey podcast at a different time. But sticking to the coffee here, he makes this point: they want to suck the last drop of $20 trillion of hydrocarbons under the sands of their peninsula. So how does that factor in? And if this is too meta, just let me know, we'll move on. But how does that factor into getting this discipline on where they're putting the money and how they're doing what they do in the US?
Yeah, no, I mean, it's critical to the energy landscape. I mean, how OPEC and the Saudis choose to navigate the increasing uncertainty around long-term demand is probably the top of the list of issues facing the sector today. And I do hear that concern a lot, that the Saudis are going to accelerate their production to monetize their reserves before the demand fades away. But what would that accomplish? I mean, selling more production at lower prices isn't a particularly practical strategy. And Abdul Aziz has proven to be quite pragmatic over the last year in restraining production to maximize revenue. So I always say with OPEC, watch what they do, not what they say. I mean, the rhetoric around sucking the last drop of oil out, I mean, I think it's what they're doing is making it clear to every other producer that they are the lowest cost producer and they will be the last man standing. But I have to assume it's about making sure others are acting prudently and restraining their investments, because the way I think about the Saudis is their hand is always over the red button and they can torpedo the price at any moment. But so as far as how we navigate that, I mean, we're just always looking for a shift in their approach to managing the oil market, and not the press headlines, but their actual behavior, because that would be a big red flag for us. They like keeping the market on their toes just to avoid that complacency of we're going to have stability, because that's when you get bad actors, right? You get lulled into complacency because of the stability of the oil price. And I think the Saudis are going to be guarding against that. And part of that is this rhetoric around, how quickly they could change their strategy.
And a last question on strategy, and then I want to drill down a bit more onto the mechanics of your view on ESG and what factors. I had a comment from an investment manager making the case on why they're fossil fuels, is that fossil fuels are a commodity and they're priced for scarcity versus renewables, which are technology, and the price is going to come down over time more stably as it scales. What is your reflection on that?
Yeah, I mean, I think when people think about commodity prices, I think too often they think about it just associated with a certain level of demand, right? And I hear this all the time, which is demand for oil is going to be lower in the future, so the price will be lower in the future. And I think the history of commodity markets would suggest otherwise, which is, as you know, if you go back to Economics 101, it's the intersection of supply and demand. And what we don't know is how the increased uncertainty around long-term demand for a commodity like oil is ultimately going to impact the supply side. And how much are we going to restrain investment ahead of time into that uncertain demand, and where do those two lines intersect? And we've just seen time and time again peak demand does not mean peak price. And I think that's something that I try to educate people on, which is, I'll be the first to admit, I can't predict the oil price. I think to be a successful energy investor, you have to start with that premise. But at the same time, I guard against the certainty on that we know that oil prices will be lower in the future.
I think, and also if you had to factor in as an investment professional, you know that everyone's pricing for risk, right? That's always sitting somewhere in the number. And the one thing, my reflection, not as a commodity investor, as an observer, is there's going to be variability, right? And how short,
Exactly.
sudden, how many other, so there's all, for me, that piece has to be in it, quite aside from whatever the geopolitics are or the mechanics of the business or which businesses are more disciplined and which are not. I did want to also, well, I don't know how to factor this in. There was an article in the Wall Street Journal on the American Petroleum Institute and how far they've come, and now they're presenting themselves as saying, well, we're happy to look for a carbon price, which apparently has caused all kinds of ructions within their organization. You've got the mega players and allegedly the Europeans saying, no, we need to do this. But then there's a long line of kind of middle and small players are like throwing their toys and shaking their fists. Both it's the carbon price and also the methane, which I do want to get to you in a bit because it is in your white paper. So for me, I mean, it was new to me to find that they're spending $200 million in lobbying a year. I mean, you can buy a lot of attention. That's a lot of lunches, shall we say, or white papers that you may or may not research diligently. So for me, it's this question of demand. And I've watched some of the language from the oil sector, and I'm sensitive to it because what I see from one sector, I'm thinking across all sectors, right? So if oil and gas can say that, well, why doesn't retail say this? Or why doesn't real estate say this? And then where does that get us? And one of the nuances they've tried is we will follow where society takes us. Shell have used us, even Shell, right? And they got slapped on the wrist by the Dutch courts recently. So this idea about, no, we're just delivering what society wants, as if society's kind of sitting there over in the corner, kind of asking for lunch. Meanwhile, we know if API is spending $200 million a year on lobbying, they're probably involved at some level in getting legislation or regulation to look a certain way and not another way. I'm very keen to hear, I mean, you can talk about industry level, you can not touch this question at all, or you can reflect on some of your own experiences working with companies and seeing how they think and talk and try and change the shape of the demand. But how do you respond to that article in the Wall Street Journal?
Yeah, I mean, listen, I think we need to be careful not to generalize when it comes to the oil industry, because I've always seen this, which is we refer to big oil and we track their actions as if it's representative of the entire industry. And listen, part of the challenge with the API is that there's so many different constituents that have different priorities, right? You've got downstream companies, integrated companies, upstream producers. I think what we're seeing is some of that cohesion is going to fray as we move through the energy transition, because everybody's got different priorities. But the way to think about the oil industry, it's highly fragmented, right? With all sorts of different companies, and there's been some very large companies with big checkbooks and political influence that have tainted the perception of the entire industry. And I get that. Listen, an industry reputation's only as good as its worst actors. I think we just always have to remember that. But I struggle with this idea that the industry creates its own demand. I mean, the consumer, more importantly for gasoline or oil, the auto industry, bet on the internal combustion engine because it was deemed to be the best combination of performance, convenience, cost. That's clearly changing. And if the electric vehicle is a superior product, the demand will follow. There's nothing the oil companies can do about it. But I also, I'm reluctant to ignore the economic prosperity that's been delivered on the back of fossil fuels over the past 50 years. And some of this blame that gets shifted on the oil companies when they were providing a product the consumer was demanding. I don't think that's fundamentally right. I'm not a sympathizer for the oil industry, but I want it to be part of the solution. And the attacking of the oil industry just creates this antagonistic relationship. The way I think about it is we have a global crisis on our hands. Let's figure out how we can all play a role in it rather than pointing fingers and placing blame. Okay,
fair enough. There's much more to unpack there. I see you're coming on ESG and whiskey. I'll let you know as soon as I roll that out. Okay, I want to pick up on in terms of the sector and the theme, and you've worked in this space for a long time, and in one of our previous conversations you had me chuckling because you're using this worked example of, do you really think that conversation is happening at the Houston Energy Club, or words to that effect, something about the mindset of some of the individuals and the corporate players who are running these companies, and they're sitting in committees and they're making decisions in air-conditioned rooms in Texas. Can you unpack a bit about some of the mindset and what tripped for me is the interview you had on the podcast with the Houston lawyers. There was the way they phrased it, and I smiled when I was listening to it. They said about environmental concerns. And I don't know about you, but I'm here. Like you've used the words crisis. It's a crisis. We got to move, right? It's polluted. It's changing. Like stuff's not enough, right? So we're moving. But in this conversation with people in the bubble who still think of environmental concerns as sort of a quaint little the Lorax story over there in the corner versus no, this is doing business in 2021, and for the rest of your lifetime, business will need to cover these pieces which somehow got forgotten for 5-7 decades. Can you talk a bit about some of these attitudes that your paper, maybe the Just Transition paper that you put out last year, some of that reaction maybe came across where you were really poking the bear a little bit?
Yeah, I mean, I think for too long, most of the oil industry, I mean, especially CEOs in Texas, were in denial that investors were leaving the sector. They had no plans to come back, and that this was an existential crisis. I mean, which is why we've argued the only way you're attracting investors back is to align your business model with the energy transition, to do things like improve your environmental performance, address the fundamental concerns around the growing terminal value risk. Because like I said, I think most management teams made the mistake for years of just thinking all the underperformance was cyclical, that it wasn't structural. And I think the headwinds from the energy transition are structural. And it's one of the reasons that we've been so vocal about the need for board diversity. And that's not just gender or race, but it's perspectives that come from outside the oil and gas industry.
Right. I was shocked to find out the board makeup on some of these companies. Like it was surprising to me.
The average oil and gas company in the US has 70% of its board members from the oil and gas industry. And you just think about the groupthink that can come out of that mentality that's shared across most of those people. It's a very insular culture, and I worry they're just reinforcing their own perspectives on climate change and the energy transition. So, one of the things we've been vocal about is that there should be more investors on boards, whether that's former investors or current investors, because I think they have a very different perspective when it comes to the impact of climate change, not just on society, but on investment portfolios. And I think that discussion over the last couple of years has been eye-opening for a lot of companies and boards, and it went from it's evolved from that's interesting, but it's down the list of our priorities to I will tell you that when I talk to an oil CEO, it is now top of the list, and I think that's a testament to the investment community and all the pressure that is being placed on these companies. And so I would just continue to advocate for investors to vocally push these companies to open up their eyes to the threats that they're facing from the energy transition.
So that creates a useful segue to pick up on a paper the paper around the energy transition, the new business model that you proposed. And there was a great sentence there. I mean, it was in the conclusion, but for me, if I was reading it, that would have been the top of whatever slide deck I prepared for the C-suite. It said, radical, not incremental change is required to make the sector investable again. I mean, that's your headline right there. So, how did you come to land on that is the critical message you wanted to get across? And then how was it received?
Yeah, I think that was where the disconnect was for so long, which is we would have these conversations. When I was at Wellington and we were pursuing traditional engagement, we would have these conversations, and it would be myself and other investors, our head of ESG, and we would be highlighting the deficiencies and the need to reform not only the business model, but the environmental performance, the transparency into disclosures, the target setting. And they would just be checking a box. We'll have a sustainability report this year, or we're going to put out a target next year. And the pace was glacial. And what we kept coming back to, and the way I look at it is a crisis, and you don't respond to a crisis with incremental change.
But remember the phrase burning platform. Literally, that phrase in management speak and MBA speak came from a burning oil rig.
Yeah. And it's a great analog. So, I mean, it goes back to why I did what I did and launched this strategy, is because my view is the only way you get radical changes is through applying real pressure, and real pressure comes with activism, because you're threatening the jobs of the board and potentially the CEO, and that's really where you see results. And so, we tried to put as much research out in the public domain around how we would reform the industry, and I think that's prompted a lot of questions and a lot of discussion and debate with the industry, which I've been proud of. But ultimately, unless investors apply pressure on these management teams and these boards, you're just going to continue to see incremental change, and that's just not acceptable in today's environment.
And I want to pick this up in our third segment, where we deal with engagement and activism and voting and so on. Because this has often been a feature of investors look at ESG factors, right? I want to pick up on SASB and some of the techniques of ESG, and to get there, I want to pick up on your discussion on this, and I'm quoting from your environmental proposals for oil and gas sector in the US. And you've got 5 proposals here, and I'll read them. Eliminate routine flaring by 2025, reduce US methane intensity below 0.2% of gas production by 2023, reduce total upstream GHG intensity by 50% by 2030, pursue routine monitoring and independent verification of emissions levels, and align reporting of SASB standards and adopt all 11 TCFD recommended disclosures by 2022. I'm going, yes. So I'm also going to say, with every report on methane, I'm glad to see it's getting much more attention. The guys at like Ben Ratner and Environmental Defense Fund, and Methane Sat, my favorite satellite, which follows me on Twitter and gives me updates from space. Australia, there's methane pollution that's just been discovered. I just learned this morning, Mexico has got twice the US methane pollution problem. So if you can't see it, you didn't know, now we have the technology to track this, right? So talk to me a bit about methane, and also I've just learned that Norway has banned flaring for decades, but it's been allowed in the North Sea, UK, and so talk to me a bit about this methane problem.
Yeah, I mean, I think it was one of the biggest underappreciated issues, and from a climate perspective, we all, I think, now understand how disastrous methane is and how it gets trapped in the atmosphere and the impact it has disproportionately relative to CO2, and it's a black eye for the industry, because so much of it is preventable, and whether that's flaring, where you're making a conscious decision to release it, or just not properly maintaining your equipment, and the amount of methane leaks that are being detected by these satellites, it's eye-opening, and it's a huge issue. So we put out that white paper because a lot of the feedback I was getting from oil and gas companies was, investors keep telling us they want us to do more, they want us to do better by the environment, but they don't tell us what they want, right? There was no wish list of tell us how to meet your demands. And so what we tried to do is have that conversation, right? We didn't do it in a vacuum. We reached out to some of the largest institutional investors. We spoke to the companies. We are a private oil and gas operator ourselves at Kimmeridge, so we understand how these things can be accomplished in the field, and we committed to all 5 of those in our own business. We consulted with Ben and the folks at EDF, because they're a lot smarter than we are on some of these issues, and have access to some great data and research. But ultimately, we put those 5 out as saying, we're humble enough to know we don't have the prescription to know all the answers, but we need some guideposts. And we called, we wanted what we called a roadmap to net zero, and it can't just be these hero statements of I'll be net zero by 2050 and we have nothing to track. Right. So when we put those 5 out, we wanted things that would be accomplished by 2022, 2023, 2025, right, and provide that roadmap. I personally think the biggest issue, particularly when we talk about methane today, is the lack of credibility around target setting. And that's because, one of the issues we highlight is that the emissions data that companies are publishing, it's all self-reported, right? And it's all based on these internally generated, engineered estimates, which is mind-blowing. They're not even independently verified. And EDF has said this publicly, they're not worth the paper they're written on. Yet that's all of the data that's in the sustainability reports and in the company presentations. And so what we've been advocating for and pushing for, like EDF and others, is science-based emissions monitoring and third-party verification. Because the more we shine a spotlight on it with these satellites or real-time methane detection, the problem is much worse than is being captured in these self-reported estimates. And it's these big events that go undetected that are having the greatest impact on the environment. And it's something that we need as an industry to shine that spotlight on, draw the attention, and make sure the companies are addressing it. Because right now, there's just no credibility behind any of these targets.
Yeah. And just on that self-reporting thing, I've been banging this drum for years, even I'll shine the light on our own industry, for example, in investment and people claiming to be ESG. I don't know if you saw the latest numbers that came out from the Global Sustainable Investment Alliance, and the European number had to shrink because there's now regulation on what you can call your fund, right? Article 9, Article 8 is kind of dark green and light green, and there's a scale down from that. And so the accounted number in now this, overall global study shrank in Europe, not because the assets shrank, but because the reporting requirement said, yeah, enough with the BS, like give it to us straight. So yeah, I'm very strong on this. Like self-reporting is close to nothing, frankly, and also in my Larry Fink article for Greenfin earlier this year, after his latest purpose letter, the day of saying I'm disclosing is like, that's just entry level stuff. It's like having an intern, right? Versus a Mark Viviano running my portfolio. Like, I want to see the performance. What are you actually doing? So very quickly on SASB, and then I've got a data point I'm looking for from you. So on SASB, kind of the dominant investor perspective ESG reporting framework, what SASB metrics, KPIs do you use when you look at, well, what do need to be my targets for this season of activism?
Yeah, I mean, I think it gets back to garbage in, garbage out. Unfortunately, even the companies that are compliant with SASB reporting are reporting data that is self-generated. And so my biggest issue is, yes, we've established some comparability because we've standardized the reporting on things like methane intensity, flaring rates, CO2 intensity relative to your production. But I still don't think there's enough credibility behind those numbers. And more importantly, my issue is companies are putting out targets that have specific numbers, but not the steps that they plan to take to get to those numbers.
It's like, I want to earn an Olympic medal. Yeah. How?
It's the same with financial guidance. You wouldn't tell investors, well, my earnings next year are going to grow 50%, and not walk through the drivers of what steps you're going to be taking, whether it's investments or efficiencies to get to that earnings growth. It's the same thing with emissions. Just putting out a target that my emissions are going to be down 30%, but you're not telling me what you're doing, which valves you're replacing, how you're going to reduce your flaring. There's just all kinds of steps that companies need to provide clarity and disclosure into on how they're going to achieve these targets. But so far, they've been rewarded by just the box checking of we have disclosure, we have targets. But there's really, as I like to say in financial reports, all that matters is in the footnotes, right? That is where all the information is. Yeah. And yet I don't see any footnotes when it comes to environmental reporting. It's just, here's a data point, and I've provided you that data point, and it's compliant with reporting standards. So I've checked that box. And that's what I'm really trying to push these companies to move away from.
I'd really like to see, don't get me wrong, 10 years ago, I was delighted that your Icon or your FactSet or your Bloomberg terminal had data points, right? It's 2021 now. I want to know that. I want to click through. You can click through the source documents, but I'm pitching the vendors on, you have the dashboard of what's reported, and then you have almost like a verified dashboard. Yeah. And imagine doing that compare and contrast, because as you've just described, there's going to be black patches where on the kind of reported side, oh, it looks like they're reporting number, but nothing's been verified. Nothing kind of checks out. Okay. deep dive 1 is always the longest, most detailed. We've had a great time. Got to move on. And here I come to land my last question of deep dive 1. I'm trying to get specific, right? And so there's one key performance indicator I'm asking all my guests. Swiss Re in 2020 announced that their business unit internal carbon levy was priced at $100 per ton of CO2 equivalent in 2021, this year. And they're going to gradually increase it to $200 per ton by 2030. So insurance company, asset manager, and. But you're working in the oil and gas sector. So question, do you track the CO2 equivalent per ton of your portfolio companies? Is it a data point you're looking at? And then also putting the attention back on your shop, do you as a shop have a number? And you're kind of different because you're private equity within an operator, so it's a bit different. But if you could answer either parts of those two questions.
Yeah, no, I'll try to answer both. I mean, like I said, from a firm perspective, at the operating level, we do track that, and we're very aware of our emissions, and that's something that we report and provide disclosure to our investors, even as a private company. But given the smaller scale of our firm, we're not at the point where we're tracking our own operational carbon footprint the way we would be doing at a Wellington. Obviously, that takes a lot of resources, and it helps when you have a bigger company to do that. But as we grow, I expect that's something that we will be looking at. I think it's increasingly important for everybody to own their own emissions. But when you think about carbon taxes, I think it's an important variable in showing our portfolio companies that they need to prioritize emission reductions. That it's not just about doing right by the environment, because there's a lot of people that will draw a line there and say, my fiduciary duty is to my shareholders, not to society. Now, I think those two are interrelated, as we referenced earlier. But I think what we need to highlight to them is that they're mitigating financial risk. I think a carbon tax is inevitable in this country. I can't tell you, when it's coming, what form it will take, what that pricing will be, but it's coming, and it's going to present a financial risk to companies who don't prioritize improving their environmental performance. So that's really how I try to frame the discussion for these companies.
Okay, and so right now, and I don't know if you can find this on the vendor dashboards, but I'm really struggling to find. So even ExxonMobil, I think 2 sustainability reports ago, said we are tracking a virtual price across our operations, or we mapping something. It was something in the $25 to $40 per ton range. And then obviously you got the trading schemes in Europe and the northeast of the US and California and so on, and then China, which is different. But what I'm really struggling, and what I want to see more clarity on, my hope by asking this question and what I'm looking for across all firms is like, we're tracking a number. Like it's still it's a gray number because it doesn't have to be black yet. But as we both agree, it's coming, right? And in the US, it is already in play in other places.
You are listening to the ESG and Coffee Podcast on Investing, Strategy and Sustainability. 您现在收听的是 ESG 和咖啡时间，投资策略和可持续发展。
Okay, so let's drop down to espresso shot 2. You ready for some short, sharp answers?
Sure.
You're doing well. And as I said earlier, this is a marathon, not a sprint. You're doing well. Pace yourself. Here we go. What app are you, Mark, most likely to be viewing on your smartphone while you're waiting in line?
I'd say it's probably Twitter. As you probably know, there's this thing called EFT, Energy Financial Twitter. It's just got great content. I mean, I'm really there for the entertainment value, but there's folks from all over the industry, and they provide some insightful commentary as well.
All right. And what book did you enjoy reading recently, fiction or nonfiction?
I just finished reading Attributes, Rich Davini. He was a retired commander. He actually ran training for the Navy SEALs. But anyway, he does a really good job making the distinction between skills and attributes, with attributes being things like adaptability, empathy, humility, introspection. And I think understanding the importance of different attributes is critical, both to hiring people and building a team, but also thinking about your own personal development. I think we place too much emphasis on skills sometimes and not about the underlying attributes of individuals.
Sounds like something we need to drop down to the elementary school level. I found out last year my grade 1 at public school was doing 7 habits of like effective learning or something. And I read it as like a distillation for a grade 1 level, like the whole Steve Covey stuff, 30 years later. So maybe that book on attributes could find its way in. Right. What is your favorite movie or on-screen moment that relates to the world of investing?
So I really like the movie Moneyball. I'm a Michael Lewis fan.
Are you a baseball guy?
I always played basketball. You can't tell from the screen, but I'm 6'6", so I was kind of naturally inclined to play basketball growing up. But I thought the book translated well into a movie. But I just love the scene where you have these old school scouts sitting around the conference table talking about the different players, and they're saying ridiculous things like, well, this guy has a great jawline, or he looks like a ball player, or they start talking about his girlfriend and what it means for his confidence. And to me, it's basically what the investment management industry was for so long. You would have these guys say things like, I just had a great meeting with management, I'm going to go buy the stock, as if the management teams weren't born salesmen telling you exactly what you wanted to hear. And it doesn't tell you anything about what the expectations are embedded in the stock. And then people wonder why have active managers not beaten indexes. And so I think in the same way Moneyball and analytics revolutionized baseball, what we're seeing is quants and investment science. It's revolutionizing the investment management industry. And my view is that over time, if your strategy can be replicated by a computer or an index, you're going to be obsolete, just like I think a lot of those scouts ended up being. So it's not an investment movie, but the parallels to me were fascinating.
That's solid. We'll find that clip and I'll drop it into the show note. I don't know if you've seen on the website, I try and add as much of this material as possible, because we hear about the human as well as the investor, Mark Viviano. Right, last espresso shot question from this set. As an investment professional, what was your most meaningful success so far?
Well, I mean, I think by far it's been what I've been able to accomplish since I joined Kimmeridge in the past year, and I'm not talking about the returns we've generated, but just the receptivity to our research and the thought leadership we've been able to demonstrate. I mean, I really do feel like we've had an impact at an industry level, and we have a lot more work ahead of us. But I do take pride in some of that early success and receptivity.
Excellent, congratulations. It's always impressive to find someone who is heading in a new direction in some way, either for them personally or for their space. So no, that's really solid. So let's move to deep dive 2 then, and it opens in a similar vein, open-ended question. Investment ideas. Where do your investment ideas come from?
Yeah, I mean, so they're all internally sourced. We've built our own proprietary screening process. We have a number of analysts in the firm, both directly on my team and indirectly that we work closely with, and they're always on the outlook for ideas. I mean, I think the key advantage we have is that we are specialists in a very small, narrow niche, which is upstream oil and gas. And so our job is to know those companies, to know the business, to know the assets as well as anybody. And I think we have a unique vantage point because we are private operators in the underlying assets as well as investors in the public sector. And I've been doing it for 17 years now. And I think as most people would acknowledge, experience does factor a lot into successful investing. So, we are always in discussions with other investors, sell-side analysts, consultants. So there's a lot of information flow, but ultimately we're sourcing our own investment ideas.
And slightly different take on that. One of the hardest things to do is let go of something. So in my view, maybe you disagree, but how do you walk away from an investment thesis, or you abandon an investment project where it's too complex, or the original idea, you had to come back and say, you know what, I got it wrong?
Yeah, no, I mean, I think it's the critical piece to successfully investing is it coming up with the investment thesis, putting money to work. That I think gets easier over time when you establish a process and you have an investment philosophy. But when things aren't going well, when the unexpected happens, that's really what I think differentiates good from great investors. And ultimately, what I've learned, through many many mistakes over those 17 years is that it all comes back to having an original investment thesis and understanding when you've moved away from that. And people like to talk about thesis drift. I mean, that happens over and over because you're talking about a dynamic market, particularly in a commodity business where things are changing all the time. And it's very easy to have that thesis drift and to hold on to stocks longer than you should. So I think what I've benefited from as I've moved into this new role is that we actually have very explicit investment committee memos for every investment that we make. And it's much easier because, like I said, we own 4 names that we publicly filed on. When I was at Wellington, we would have portfolios that would own 50 or 60 names. And so there wasn't the same degree of rigor behind every position because it wasn't as concentrated, right? You'd have companies that were 0.2, 0.3% of a portfolio. Right. When stocks are above 50% of your portfolio, it's a different degree of rigor. But within those investment committee memos, we are very explicit about here are the things that would change our view on the investment. Here's our investment thesis. This is what we're looking to accomplish. And here is how we think about potential triggers to exit the investment. And I think sticking to a process like that, being able to go back and say, this is what I was thinking about when I made the original investment is critical to maintaining, to being true to yourself and to your thinking.
Right. And so related, so I've watched with interest. Before I move on, the memos, 6 pages like Amazon. How long are those memos?
They're roughly 4 to 7 pages depending on the investment.
Okay. So something I've seen the head of research at ARK Invest, Kathy Woodshop, do well is he explained on the Odd Lots podcast, he explained that one of the things they've enjoyed is the see-through that the research part of the business has had in terms of developing investment ideas and being credited with investment ideas. And, there's different points of view, what have you, but I'm a big fan of, Lennon and McCartney always split the credits for any Beatles song, even though one wrote it more than the other, right? So I'm of the generosity mindset that put as many names on the team as possible, and they all helped in some way. But I say that to say, Bob Seawright's The Better Letter wrote today, and he quoted a conversation he had with Kahneman, the Nobel Prize winning behavioral economist. And Bob had asked, what do you do about implicit bias? And Kahneman's point and research had been that even very smart, intelligent people who try to be careful not to have their biases and not to kind of make the wrong decisions, they still have this problem, and sometimes even worse, strangely enough. So Bob asked Kahneman, what might we do to mitigate our inherent weaknesses in this area? And Kahneman said, well, not much. And then he paused, tilted his head, and added, ask the smartest and least empathetic people to tear your ideas apart. So I'm not sure if Energy Financial Twitter does this for you, but where do you go to not be in a bubble like we've described some of these C-suites are? How do you beat up your ideas? And are you able to do that in public? Do you do that inside the shop? How do you do that?
Yeah, I mean, I think, I spent a lot of time trying to read about behavioral economics because I think it's actually the most important driver of the way markets work. And I, looking at my own career, looking at blind spots of myself and others, I think the biggest issue is confirmation bias, that we overly seek out information that makes us feel better because it confirms our thesis. And I think that is the most dangerous thing you could do in investing. I also think it's dangerous for an executive of a company who surrounds himself with a board that doesn't challenge him and basically confirms everything they're doing. But the way I try to guard against that is, and I've tried to do more of this over time as I've evolved as an investor, is trying to seek out the other side of the trade. That you can't make an investment unless you know who you're betting against. That for every share that you're buying, somebody is selling, and why are they selling? And so how do you do that? Well, as you point out with Kathy Wood, you could do it publicly on forums like Twitter or Reddit. We don't do that. But the good thing about investing in a sector for 17 years is I think I know all the players by now, and whether that's other investors or sell side analysts, I generally know who to go to understand all the different perceptions around an individual security. But what I really want to see is, what is the bear thesis? If I'm buying a stock and I think that there is a way to see it increase in value, somebody's betting the opposite. And I want to understand the dynamics of their thinking.
Okay. And another question for you in the space of kind of how the investment business works and the humans who are making it happen. For me, I'm a strong proponent of ethics influence the markets, in as much as life is a ethics test. Every day you're making small or large decisions, and it'll play out at some point in your professional career. What is your view on ethics as an investment professional?
I think it goes back to the book I was referencing on attributes, right? You can be a very skillful investor, but what are your underlying attributes? Are you honest and ethical with your clients and business partners? What happens when things go wrong? How do you react? Is there humility and accountability? There are a lot of unethical people in the investment business. I mean, let's be honest. It's just the nature of the beast when there's so much money at stake. My view is it always catches up with people eventually. And when I was at Wellington, the saying that got passed down through the partnership, it was kind of the ethos of the firm, was client, firm, self. And it's pretty simple, but if you just look at every issue through that lens of prioritizing what's best for the client, then what's best for the firm, and then what's best for yourself, you're generally going to come to the right answer. And so that's continually how I try to approach any issue that may arise from either an investment perspective or a business perspective.
Okay, so let's look a bit at performance now, and let's start first with yourself. How do you rate your own performance? What KPIs, on a screen in your life, how do you measure your own performance?
Yeah, so I think the difference for what I'm doing versus what I used to do or what others do is my performance is not benchmarked. So my performance is evaluated on an absolute return basis, and we establish a hurdle rate that we think is aligned with our clients' objectives and targets. But like I said earlier, if we make our clients money, again, from an absolute return perspective above a hurdle, we capture some of that through a fee. And I can't go into the specifics, but that's generally the alignment that we're looking to foster. And so that's what I'm focused on is absolute performance.
And let me also pick up the fact, I didn't realize you were tracking 4 counters, 4 names, right? So that's very, in a way, it fits completely that you're in a private equity context, because that's almost private equity levels of concentration and focus, right? You're not screening 3,000, you're not tracking 100. That's very focused, yeah.
Well, and I think it has a lot to do with what I've talked about, is like, you don't have a viable business going forward in the investment management industry if what you do can be replicated by an index or a computer. Yeah. And my job is not to give people broad representation of the energy sector. You can do that a lot cheaper, a lot more efficiently than giving us money. We intend to provide differentiated returns, and we want to do that through different levels of engagement and activism that you can't do through an index or a computer. But the other reason we've set it up the way we did through a more private equity structure is I believe the biggest advantage you can have in the investment business is not having called strikes. This idea that you have to be invested all the time. And you got let a lot of pitches go in this business. So you're not swinging at everything and waiting for that fat pitch down the middle, something that Warren Buffett's always talked about. And so when people commit capital to us, it doesn't get invested right away. We have the ability to call that capital when we see opportunities and invest it accordingly. And I think that is the right way to invest. And so when we set up this structure, we started with what's the right way to design an investment portfolio. And it looks very different than most of the investment management industry for public securities today.
Got it. Okay, I want to talk a little bit about the trade-offs of ESG and then come into land on deep dive 2, talking about greenwashing. So in terms of ESG performance, so you're looking at, said 40 to 50 companies are in the sector broadly. So how do you decide between your targets, when you look at all aspects of the firm, financial aspects, management aspects, quality aspects, environmental, social governance, how do you decide how to weight those? And have you ever been confronted with situations saying, yeah, they're really strong on their capital discipline, management quality, very humble humans, and they're doing the right thing, but they really suck on the, on the social, they are underperforming on the social aspects. And then you've got another one, which has got different permutations of these various factors. How do you decide between these two entities, let's simplify, two entities where they've got different permutations of all these components? How do you choose?
Yeah, and I think it's like everything in investing, it's a compromise, right? Because everything is across some spectrum. I would say there's no company I would highlight as the best or the worst on a lot of these ESG issues, because they all have their deficiencies and their different degrees and scale. What's unique about what we're doing, obviously, is that we're actually looking for those deficiencies, which is, I think, what most people screen for is, I want to own the best companies on a lot of these metrics, and we're often screening for which companies are the worst, because what we're trying to do is improve the laggards, and by doing that, we think we can find dislocated valuations that can improve as you address some of these deficiencies. So we've got a very inverse screening process from what I think a lot of people who you'll talk to on ESG metrics look at. When I think about the prioritization of it, I mean, I think the biggest impact you can have is reforming the business model, right? So the idea of reinvestment rates and return of capital to investors, I think that is the biggest issue. But that is also connected to governance and alignment of how management teams think about their investors and what they're prioritizing. And then, I think environmental performance is critical to attracting investors back to the sector. So, we don't just choose one of those. When I think about what we've established as the three pillars of reform, they all need to be addressed, and we're looking at deficiencies across all the spectrum of all three of those.
So it gives me an opportunity to mention now, I was at a Harvard lecture by Ian Conn, one of the four bagmen for, was it Lord Brown? They were all competing for his job, and then Tony Hayward got it.
Yeah.
Yeah. So, and then I've seen Lord Brown speak at Harvard, in which he described the world's worst oil disaster as a bit of a problem in the Gulf, right? At which point I nearly strangled him. I was in the front row. The story for ESG and whiskey. We've got a lot to cover. So, but I want to give you a minute or two, because I know you've spoken very coherently and compellingly around executive compensation in this space. Could you give us a minute or two on what's wrong and how to fix it?
Yeah, I mean, I think the underlying issue that we've highlighted is just the utter lack of alignment and then accountability. And the easiest way to think about that is, over the last, this is something we just highlighted in a recent white paper, is that the median decline in compensation for the US E&P sector, for the companies that we looked at that had the same executives in place over the last 3 years, was 1% since 2018. And that median pay level was $11 million. And over that period of time, the median stock price performance was 60%. So, I don't think it takes somebody to do a deep dive on executive compensation to notice that there's utter lack of alignment there. And so I think it's a fundamental issue for bringing sector investors back to the sector, which is this whole premise of heads I win, tails you lose. The shareholder suffers, and the executive continues to be paid. And to me, that comes back to the board. And where is the accountability? Because boards are in place to represent the shareholder. And as we've said, it just seems too often they're there to protect the wealth and livelihoods of CEOs. And so until we address those underlying issues, I don't think we've addressed the root cause of the problem. That goes back to the operating model, environmental performance. I think those things all go back to what are CEOs incentivized to do, and where is the alignment with shareholders?
It was stunning to me, the CEO of ExxonMobil getting huge chunks of money over the last 3-4 years, even as things went pear-shaped. So, but do you even, I mean, is this going to be a case of an incumbent or a new entrant coming in with a different model? Because I don't see humans in wood-paneled rooms, the air conditioner on the 40th floor, saying, "Yeah, guys, let's carve our pay." Like, how's this going to happen?
And I will tell you, for all the things we've put out there on the operating model, environmental performance, governance, this is the most controversial, because you're right. I mean, people don't voluntarily pay themselves less, and I think we all know. The person that nominates people to boards is generally the CEO, and so you've surrounded yourself with people that are there because of you. I mean, that feedback loop. We highlighted this in our original governance paper. You think about what that discussion looks like, and what that negotiation looks like. The quote we talked about was, you're at a negotiating table with nobody on the other side, because the only person that's going to hold you responsible is the shareholder, whose only real voice for most shareholders is a say on pay vote, which is non-binding. Right. And generally what the companies hide behind, and this is my biggest frustration, is everybody else is doing it. Right, that it is a commonality across the sector. Right. And what I like to say is I don't let my 5-year-old get away with everybody else is doing it. So why do we let CEOs and boards of these companies do it? So I agree with you that you need somebody to take a leadership role. And ironically, what we're seeing on that front from the oil and gas sector is a lot of the emergent bankrupt companies, because they've got a new board in place that's generally been put there by the creditors or now shareholders, and a new CEO. And what so if we look at the greatest rate of progress in reforming executive compensation, it's been in these previously bankrupt emergent companies. But fortunately, what they're doing is putting out a template that now we can point to, because the challenge I would get early on is companies would say, well, okay, that's interesting, I understand your perspectives, but show me the companies that's doing it so that we can just copy it, because we don't want to take that risk of moving out of the fairway of doing what everybody else is doing. So we are seeing progress. It's slow. But we are seeing companies adopting some of the things that we've advocated for, which makes it much easier for me to then just point to an example and say, well, this is what we like. And so part of what we did in the latest paper we just published was highlighting where we're still seeing deficiencies, who we think are the laggards, but trying to hold up companies that are making progress. Because I think it's equally important with all these issues to not just slam companies, not just criticize companies, but hold up the companies that are doing things right and are making differentiated progress, because that's how you'll get people to follow.
I feel very strongly in all of this and all of life, frankly. You've got to give people on-ramps and off-ramps, right? Everyone can make a bad decision. You got to find them, help them find a way out of there. So let's come into wrap deep dive 2 now, the greenwashing question. Do you agree greenwashing is real, and does it hurt what you do?
I mean, it's definitely real, and I think it's pervasive. I mean, and on all sides of the equation. I mean, I think it's on the investor side and how they use it to fundraise. It's on the company side, and this idea that we were talking about before about putting glossy sustainability reports and checking boxes, but it's not clear what actually is changing. How it hurts us. I think it does give companies cover to hide behind, and some part of what we're trying to do is educate people on the differences between box checking and real impact on the environment. And then, from a fundraising standpoint, everyone calls their strategy green or ESG compliant or sustainable. I mean, we haven't done that at all, and maybe that hurts us. But I look at a lot of those strategies, and they just own the same companies that are owned in large indexes, and they like to talk about engagement, but how many of them can actually demonstrate any impact? So it's funny when I see company funds call themselves impact funds, and yet it's not clear what impact they're making. But I'm not here to throw stones at others.
Right.
You're listening to the ESG and Coffee Podcast, hosted by Graham Sinclair. Sie hören den ESG and Coffee Podcast. Ihr Gastgeber ist Graham Sinclair.
Right, let's land deep dive 2 with espresso shot question set 3. Short, sharp answers. You ready to go?
Sure.
Do you have a favorite type of tree, and what is it?
It's whatever's in my front yard. I actually think it's a peach tree that just never ripens because we live in Massachusetts. But once a year, it blooms these amazing pink flowers for 2 weeks, and the family
Wonderful.
really looks forward to that every year. And I have people come by and I say, "What kind of tree is that?" And I think it's a peach tree, because you'll see these little green fruits that never ripen.
Yeah.
They fall. Squirrels love getting the pits, but I think it's a peach tree.
You haven't found the tree. Give you a little note. Please send me to warmer climate. Can make.
It really struggles for most of the year, but 2 weeks a year, it's very happy.
All right. Well, we need one of the leaves. There's an app that you can like take a photo of the leaf and the apples.
Oh, is that right? All right. That's how
This is why you come on the ESG and Coffee podcast.
I'm learning a lot here.
All right. Question 2. What one book on investing would you recommend?
I personally think the best book on it's called Hedgehogging by Barton Biggs. He used to be the head of strategy for Morgan Stanley, I believe, back in the day, and then he started his own hedge fund. But the reason why it's great is it's basically a diary of him starting a fund and investing, and it's really the lifeblood of an investor, and kind of the ups and downs and mental anguish. And it's so different. Every other investment book is here's how to invest. Yeah. This is like what it's like to be an investor, and I think he captures it better than anybody I've read, and I can relate to a lot of the emotional roller coaster that he depicts in there.
Fair comment. I'd like to suggest we might give a slice of that on this podcast. How is your own retirement fund invested?
Well, it's funny because I left Wellington last year, I cashed out my 401k, which everybody will tell you never do, because there's obviously tax implications. But I put it all into my new strategy. So my view is, if you can't bet on yourself, why would you want any other people to bet on you? So I am not diversified at all, and probably break every rule, as you know, when we were just talking about owning 4 stocks. But that is where that's basically all my liquid net worth at this point.
Which side of the V-shaped March-April did you do that on? Please tell me you timed that a little bit.
The timing where I cashed out in January and put the money to work
no, you're a rock star, man. You should write a book.
Well, listen, timing's everything in this business, and I've been on the wrong side of time.
Yeah,
so there you go. You get it right. But in January, I had no idea a global pandemic was.
I really respect anyone who's done any kind of reporting over the last year, and they start with that sentence, like, I did not know this is coming. Like, then they kind of score half a bonus point on that. All right. What advice would you give to your 17-year-old self?
Learn how to program. I mean, I took some computer science classes in college, but I didn't. I wish I understood early on where the world was going from a computer science perspective. Because not that I would have necessarily gone into a different field of technology, but just thinking about like the benefits of understanding how to program in the investment world and being early in that. I think that would have been a huge advantage. So I wish I had spent more time on that.
Fair comment. I was in the same advanced high school computer program as Elon Musk.
Is that right?
Is a story.
That is a claim to fame, yeah.
What is your advice to people seeking to enter the field of investment finance and ESG tomorrow?
Well, I think you'll catch a common refrain here, but I would say to people, you better have an edge that's not going to get competed away by computers or an index, because I think the investment management industry is forever changed, and it is going to continue to get more and more competitive.
Okay, right. Let's go to deep dive 3, the shortest of our deep dives, and then we'll wrap with the Goldilocks question. On engagement, it's obviously, when I'm interviewing portfolio managers and investors, they kind of walk me through their approach. You're kind of a special case in a way, because all of your work is engagement. But I've heard you also talk about the kinds of engagements you had in your previous role with a large investment manager versus your experience, which led you to think, it's got to be more than engagement, at least with this sector that I'm working with. It needs to be activism. Could you explain that evolution of your thinking?
Yeah, sure. And honestly, I just wish people were more open about how little impact traditional engagement has on catalyzing change. I mean, companies are great at listening and complimenting your ideas, but nothing ever really changes. I mean, and I'm only talking about my sector. I don't want to make broad generalizations because maybe it's different experience for others. But I think generally the case is people oversell the impact they can have through traditional engagement, because to me, it comes back to the carrot and the stick. The carrot of just, I can buy or sell your stock, it really doesn't accomplish anything. And so what I wanted in the toolkit was the stick. And your your expectation should not be, I need to use the stick a lot, but having that in the toolkit, and the companies knowing you have that in the toolkit does change the dynamics of those discussions.
Okay, and then a piece of this for me is seeing what played out. I wrote a piece for Greenfin on what happened on the 26th of May this year, the Chevron annual meeting, the Exxon annual meeting, and then what had come through earlier that day from Shell and that Dutch legal case. The Dutch legal case itself, how the judge said, no, as Royal Dutch Shell, you've made all these promises, they don't really check out, so you need to get real, and you need to get real on this timeline. Do you have a view on that? Did you look at that? Has that helped inform your approach that you're doing with in the US?
Yeah, I mean, the way I think about it is it's just clear to me we're in the early innings of climate change litigation, and that's obviously a slippery slope when you're talking about jurisdictions and public companies that have responsibilities to shareholders. But and what I worry about, and this is something you and I have talked about, is it's only going to accelerate the trend of migrating assets into the hands of companies that aren't under the same degree of scrutiny or that type of jurisdiction, which I'm not sure is the best thing for the environment. But ultimately, I think what it is trying to get to is accountability, which is if you're going to make pledges to the public, to your shareholders, you better follow through on it, and it better be transparent and concrete. And that is, that I applaud. But the way of doing it through the courts, I'm not convinced that's the right answer.
That will be, for me, it's an edge. It's a piece of the playing field. The other piece that came through this week, Gary Gensler at the SEC has got a timeline for by the end of 2021. The SEC's taken all the input they want on climate disclosures, ESG disclosures, and they're going to have some kind of draft for public comment by the fall of 2021. So, as soon as unless it gets lawyered, and one of my least favorite things is seeing these long disclosures to our earlier disclosure conversation, where it's clearly all lawyer speak. And if you have the same law firm, they copy and paste from client to client, right? But if it is meaningful, if it is fact-based, if it is verified and in formats that we can actually use, what the SEC is able to do, that will help clarify and take away some of that grayness, in my view.
Yeah, no, I agree with that. I mean, the analog I like to use is that oil companies are responsible for reporting their reserves. It's SEC mandated how they report them, and those reserve disclosures need to be audited by a third-party auditor, and they actually disclose what percentage of the reserves have been reviewed and audited. That is where I think environmental performance is going and needs to go. And whether that's decided by investors and companies get there on themselves, or it's mandated by the SEC, that remains to be seen. I mean, I'm optimistic that the SEC can play a role in this, but ultimately it comes back to the credibility of the reporting, and it has to be audited. We wouldn't let companies come out and disclose their reserves without independent verification, particularly if they're going to be paid for that. And that's the hazard I see out there today, is that, as you know, a lot of executives are putting environmental performance and metrics in their compensation, but yet nobody's verifying this data. And as we said, it's internally generated. So to pay an executive based on internally generated data points is deeply concerning to me, and it should be concerning to other investors as well.
Yeah, there was a misstep, legendary misstep I referenced in one of the academic articles I wrote, was when Shell, this is about 2010, had tied CEO compensation to how they ranked versus peers in the Dow Jones Sustainability Index, influential index tracking sustainability. It has its own kind of merits and demerits. They did not provide, and so this is exec comp, they did not provide for when Shell got stripped of their ranking for, and this is that scandal about their reserves reporting or something. I can find the article, I'll put it in the show notes. But it just illustrates, whatever you're tying the exec comp to, make sure that's a rock, not a piece, not sand, because if that moves, you're in a bit of a bind. Okay, so moving then to voting, and here I'm not sure what your answer is, and tell me if this is, we can move on if you don't cover this piece. But how does what you do intersect with the annual voting at the companies that are in your portfolio?
Yeah. So, I mean, as you know, because we've discussed it here today, the portfolio is highly concentrated. So it's very different than when I was at Wellington and we would have to vote across a large spectrum of companies. This is very specific. And for each of the investments that we've made, we had engagement objectives coming in. And so a lot of the influence we have is behind the scenes, usually ahead of the actual voting. So to me, how we vote in the proxy statement is less important than what changes we're pushing for at the individual companies.
Okay. And then take me, so I wanted to touch quickly on the engine number one led investor action at ExxonMobil, and then talk about divestment. And then I've got some forward-looking ideas I want to pull from you. So very quickly, what is your, and I appreciate that in some ways they're competitors, so thank you for being collegial and thinking and talking about it. But engine number one was for me the tiny part. The big part was what all the ETFs, what all the passive investors, the State Streets and the BlackRocks and the Vanguards and the Fidelities, how they voted, or the asset owners, CalPERS and ABP and so on. What is your reflection as an investment professional and the strategy that you have when you looked at how things played out on the 26th of May and the subsequent days when they found out a third seat had been allocated? How do you reflect on that?
Yeah, I mean, listen, I think it was a landmark event, and I think Exxon vote is just another clear indication that this industry has fundamentally changed, and investors are going to have little patience for companies whose capital allocation philosophy and environmental strategy are not aligned with the energy transition. And the publicity that's attracted because of the size and stature of the target, I think has really enhanced our ability as well to influence the sector. Because I will tell you that it sent shockwaves through the boardrooms of these companies. To think that a company with that size investment could get 3 directors on the board of a company like Exxon makes these companies all realize they're vulnerable. And that's great, because if you want change, companies have to believe there is a vulnerability. And so I don't look at them as a competitor. I think of them as pushing an agenda that we believe in as well. And I think there's a lot of commonalities around the ideas that we had both put out there on how you need to align this industry with the energy transition. And so to have them do it with such a public profile, I think it's only going to allow us to effectuate more change going forward. So I applaud what they've done, and I do think it is very significant event in the industry.
Okay, great. Let's come into wrap part 3 now. With a question, ESG in 100 moments. So I'm working on a book project. Gene Rogers, the co-founder at SASB, encouraged me to do it, so it's happening. More a coffee table book, not an academic tone, but like 100 moments that were significant, that helped shape the whole investing in ESG space. Put yourself in a situation, you've just read through it patiently, politely, while I made you coffee, and you put it down and you said, well, hang on, Graham, you've missed a big item. You've missed my favorite ESG moment that should be in your top 100. What would that be?
Well, I mean, it's easy because we were just talking about it. I think the Exxon vote, I think we'll look back at that at a defining moment, because as you said, it wasn't just engine number one. It was the involvement of BlackRock and State Street and Vanguard and the passives really shifting from passives to this idea of activist engagement and holding companies responsible. I just think that we've changed the game because what it highlighted was it's not about how much you own, it's the message you're delivering. Because to me, activism should always be about what voice you're providing to other shareholders. When you're a minority shareholder, it's not what you want, it's what the broader shareholder base,
all of us want,
what all of us want. And I think what engine number one did is provide that mouthpiece. And you can see how much it resonated with other investors. And I just think that is really a monumental moment in moving from what I've talked about as engagement not being effective to the power of activism.
Excellent. Great.
You're listening to the ESG and Coffee Podcast, hosted by Graham Sinclair. Вы слушаете ESG and Coffee Podcast. С вами Грэм Синклер.
Great. Let's come in with the espresso shot for our last set. Are you ready?
I am ready.
Here we go. What is your favorite word?
Favorite word? I'd have to say I love the word catalyze, and because I think it has so many implications when you think about investing and climate change and making a difference, and it's all about catalyzing change. So I use that word a lot, and I think it's highly effective in explaining what we're trying to do.
I'm an analyst. I'm going to control F all your white papers now after we're done. What is your least favorite word?
Me or I. I mean, I just the inability for people to see a world outside of themselves and the need to take credit for so much and the lack of humility. I just think there's too much of it in this business.
I'll reflect back to you. I was typing an email yesterday and I had too many I's, and I literally reworded. I don't like it. Yeah. What profession other than your own would you like to attempt?
So when I was growing up, I always wanted to be a marine biologist, and I was just kind of fascinated by the ocean and all life underneath it. And my life took a very different path. But
did you grow up near the ocean?
I grew up in New York, but my family had a small summer house in Rhode Island, so I spent a lot of time by the ocean and was kind of always fascinated by that and going to aquariums. My favorite animal was the killer whale, which if you go back to Our Planet documentary, there's some really cool scenes on killer whales in there.
Yeah, absolutely. Yeah, special. We got to look after them. And I recently found out, did not know, there's a pod in the Gulf.
Right?
I didn't think there was one that cruised around there. I'll try and put it in the show note. Yeah, I'm like, really? There's down there? I always associate them with kind of cold, clear waters, right? Either South Atlantic or North Atlantic. But so. And what profession other than your own would you not like to attempt?
That's a good question. I mean, I don't think I'd want to be an oil and gas CEO these days. There's
going to be some vacancies. I've got a running bet with someone. There's going to be a vacancy at a big place soon.
I think I'll stick on this side of the table.
Fair enough. You're smarter than you look. Yeah. What attribute does an excellent investor have?
What attribute?
Mm-hmm.
Humility. I mean, I just think anybody who's not humbled by the markets, it just doesn't have any degree of accountability or introspection, because it is a humbling beast.
It's almost like you would love to spot it in that first intern interview, whatever, or the first year intake of analysts or something. How could you put them in a situation where not what they say, but how they act makes it clear?
Well, and it's fascinating if you think about it, because we've had basically a 10-year bull market in anything but energy.
And everyone's
so we have a lot of humble energy analysts. I don't know if most of the investment community has been sufficiently humbled when you think about the younger generation coming in.
No, I agree. Well, they're going to learn soon enough. Which living person do you most admire?
I'm sure this is an answer you get a lot, but I just have a tremendous respect for my parents and the selflessness they displayed, raising us and prioritizing us. And I think you don't appreciate it until you become a parent yourself. And I think that's always been kind of a fascinating aspect of having your own kids, is being able to look back then at your childhood through a different lens than you had, and you understand sacrifices that were made and how your parents were able to put you first, because that is, to me, what parenthood is about, right? Is you find something that is more important than yourself. And I just think it's a really valuable lesson.
No, thank you for sharing that. I think it's really powerful. And yes. What is your greatest extravagance?
My bourbon collection. So I think you've referenced the whiskey podcast, but
I'm available.
that is that is my one hobby outside of oil and gas and raising kids. Is I do have quite a bourbon collection now. Now that helps because it's something you can consume and relieve stress. So it's got some practicality to it. But there's a few rooms in the house filled with whiskey, which my wife keeps telling me that as the kids get older, we have to start hiding. But yeah, that's my extravagances. I will spend more money than I probably should on a bottle of bourbon.
There you go. As an ESG guy, I have a great collection of bottles that I do promise I'm going to turn into glasses or vases at some point. I'll get back to you on that. What talent would you most like to have?
I think what I was talking about earlier, programming. I mean, I think I that's kind of passed me by at my age to think that I'm going to pick up a new language.
Girls can code, mentor something with the girls. Come on, there's.
Yeah, no. Listen. My priority is getting them into coding and things like engineering early on, because I think that's invaluable and it's only going to become a more important skill.
Okay, great. And what do you consider your greatest achievement?
Outside of the discussions we talked about with work, the greatest achievement is bringing life into this world. I mean, nothing makes me more proud than seeing my kids grow up and seeing the people they're becoming and having some influence on that. I mean, I just take a lot of pride on that. And listen, I don't have teenagers yet, so I'm sure that it'll go off the rails at some point. And it'll be harder to claim any sort of achievement. But to date, I've been very proud of the young women they're becoming.
We'll play this clip from the interview for you every morning through the teenage years.
Exactly. While I'm drinking my whiskey.
Dad, that's not orange juice. Are you? Yeah, some of that. And then last question: what is your idea of perfect happiness?
Sitting on a beach with my family and a good glass of whiskey. I mean, that's all I need to be happy.
Right. Twilight, late afternoon, what time of day?
I love the sunset.
Nice.
Love the sunset.
Nice. And what is your go-to picture of that? Is that West Coast? Is that East Coast? Is it Caribbean?
So, we haven't traveled a ton outside of the US with the family, although I'd say if you ask my kids what their happy place is, it's an island called Anguilla, which I don't know if you've ever been to. It's a beautiful Caribbean island that's relatively undeveloped compared to a lot of the bigger ones, and it's a little harder to get to. There's no direct flight from Boston. You got to make a connection, which in some ways keeps away a lot of the riffraff you see.
Yeah,
but it is just a beautiful island, and you actually feel like you're escaping the world, which is all you want on vacation. So that is my kid's happy place, and by definition, that becomes my happy place.
Wonderful. I had a mate who was living in the Boston area who, through COVID, ended up on a 6-month staying in the Caribbean because house moved something, family, and then he ended up on an island for 6 months. That worked out all right. All right.
A little different than Boston.
Yeah, a bit different. Right. So as we come into wrap now, I'd love to give the guest the opportunity to ask the audience an action question. So a call to action. What do you want our listeners, and they're all along the investment value chain, could be a trustee, could be a wealth manager, could be a professional investor, could be someone who's curious about the industry or just started. What one thing would you like them to do today or tomorrow to move forward, the way you want to move forward?
Yeah, I mean, I think it just comes back to accountability and holding management teams of public companies accountable. And I think management teams are very smart and sophisticated when it comes to telling investors what they want to hear. And I'm just continually surprised at the complacency around, we voted against this or we voted against that, and not being willing to take a more public stance against what we're seeing from some of these companies, particularly in the oil and gas sector, which is really obviously what I'm referencing today. So the more that investors speak out publicly, rather than just the behind the scenes engagement and the voting, which, as you know, is non-binding and non-attributable, I think we'll really see an acceleration of change.
Excellent. Okay, so to my final Goldilocks question. Tesla Incorporated is an American electric vehicle and clean energy company based in Palo Alto, California. Maybe you've heard of them. One share of Tesla is trading today. I just checked while we're on the interview. It's around $691 US. It's up again over the last few hours. So it's never flat. It's always up or down. My question to you, Mark Viviano, professional investor, is the price of Tesla stock too high, too low, or just right?
Well, I think the one thing we know with markets is it's never just right. There's no Goldilocks scenario. I mean, if I had to take a side, I would say it's too expensive, and that has nothing to do with my view on the product or the future of electric vehicles. I mean, I think that is where we're headed. I just think what the stock doesn't properly reflect is the competitive nature of the auto industry and where the rest of the auto industry is headed. And ultimately, the valuation is a representation of the moat, the strategic moat they have. And I just think that they've had a head start, but the competition is coming fast and furious. And I just think at some point the valuation will catch up with those competitive dynamics.
Fair point. A good answer to the Goldilocks question. Encouragement: don't opine on Twitter. It could be a long afternoon for your account. You've been a fine guest, Mark Viviano. You're one of the originals. Thank you for your hard work over many years, making new paths in the practice of investments and ESG. I like to say the investments you make become the world that we live in. So thank you for trying to make it better, even in a difficult sector. And thank you so much for coming on the ESG and Coffee podcast.
Well, thanks for having me today, Graham. Really enjoyed the conversation. We touched a lot of subject matter, but really appreciate the deep dives and some of those really original questions.
Good man. Thank you.
And now we keep the tape rolling to hear from Graham and his guest as they reflect on their discussion and anything they wanted to add.
And so to the bonus tape now with my guest, Mark Viviano. Mark, on the bonus tape, I'd like to kick back, relax a bit, and think about, really meant to talk about this, forgot to talk about that, or let me clarify or correct something I said. Is there anything you'd like to cover that we haven't covered, a question I didn't ask you really want to answer?
No, I mean, I think you covered all of it, which was pretty impressive, and it was a thorough conversation. So there's nothing specific that stands out in my mind that was yet to cover.
Okay. I want to pick your brain on, and we talked about this in one of our previous conversations, I think. So this whole, like, who owns what in the oil and gas sector, all the way down to my recent finding last couple of months from an article that there's all these abandoned oil wells in Colorado. I didn't even know there was like a lot of oil in Colorado. Who knew? I didn't, obviously. So what do we do about, or what is your view? Does it fit into your investment thesis, or it's not something that factors in? Like, what about all these abandoned oil wells that eventually, I'm assuming, taxpayers have to fix, and or they're busy leaking methane or something? What happens about those? Yeah,
no, it's a great question. It's something that we've actually been looking into. We have a private oil and gas business in Wyoming, and it's something that we're aware of, which is there are a ton of these old abandoned wells that are leaking methane into the atmosphere. And we've had discussions with political officials and trying to understand what role we can play in trying to properly abandon those wells. And the issue you run into is right now, there's no incentive structure to compensate for that emissions reduction that can come with shutting down those wells properly. And the way I think about it is there is a carbon trading system that allows for credits if you plant a tree, but not for shutting down wells that we know are leaking into the atmosphere. And that is a fundamental problem.
Crazy, yeah.
So that's something we're trying to advocate for. And we actually put out a white paper calling for the industry to set up its own carbon trading exchange where you could get credit for doing those things. So it's in its infancy, and that's something we're trying to get off the ground. But you know, the idea that we're prioritizing planting trees over shutting down leaking wells, it just doesn't resonate with me, and it shouldn't resonate with anybody.
Okay. And one thing I like to probe or encourage my guests to do is, how do we get you on the investment committee at your alma mater? I want more skills. And like one empty space for me is I've met some investment committee people at university where I've been teaching at B schools, or just I have relationships. And, they're great professors and they're very intelligent humans, but they don't do investment decisions every day. So how could we get Mark on wherever your alma mater is?
Yeah, that's a good question. It isn't something I've necessarily thought of, but I'm aware of the issues you're talking about because I've spoken with many investment committees over my tenure, and you do see a real difference when you have investors on the committee, and whether that's a former investor or a current investor, somebody that understands the dynamics of the market and the psychology of an investor, I think is critical to thinking about asset allocation and how to allocate resources properly. So I'm all in favor of more investors on investment committees.
And I nominate you. Report back in 1 year. Thank you. If you have no further questions, I have one question from a 10-year-old who's rather important to me, who loves cars as I do. I'm one of those unusual people. I enjoy F1, but I have learned to love Formula E because we need to move to electric drivetrains. So here's this very short question.
My question is, when the world goes all electric, how are you going to explain yourself for investing in oil and gas companies?
It's a great question. What I would tell him, and what I try to educate a lot of people on, is that the oil demand that comes from passenger vehicle miles, so me and you driving our cars around, is 25% of total oil consumption. And so when we think about EV penetration, and you talk about 70% EV penetration by 2035, or whatever your view of that scenario is, that's what you're substituting, 70% of the 25%, not 70% of the 100%. And so what that means is oil is pervasive in our lives, like it or not. Everything we touch, the toys you touch, your phone, everything's got petrochemicals and oil in it. And what that means is we're going to be stuck with oil for a long time. And that's my view of why we don't abandon the sector and why we need to reform it, because we are going to rely on it. You can look back at historical energy transitions. They take decades, not years. So as much as we want to fast forward to a world where we don't rely on oil and gas, unfortunately, that's just not reality. And so instead of trying to divest of the sector or criticize the sector, what we're trying to do is reform the sector and understand that it has a place in society, but it needs to be a better actor. It needs to improve its environmental footprint. It needs to improve its governance, and it needs to align its operating model with the energy transition, which is exactly what we're focused on.
And we haven't even talked about, this. We got to get you on another interview because we haven't even talked about the whole pivot to plastics, right? Which is a whole different climate problem. Your comment on like where most of the pollution's in the scope 3. I was really surprised at an interview with Alan Jope, 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 the CEO of Unilever, and he said 65 to 70% of their emissions is scope 3. I didn't realize it. So it's actually unusual in a way that it's so similar that all of the pollution is in the way you use it. Well, you've been a fantastic guest. I've really enjoyed this. We will be posting this interview shortly. Thank you so much and have a great day. Have a good weekend.
Thanks, Graham. Really enjoyed it.
I really enjoyed the conversation with Mark Viviano. Covered some territory I didn't expect him to cover, and in a sector that we really, really need to change. 4 high points for you quickly. 1, do your job. Mark started making investment decisions for his personal account, I guess, back in 1999, and he was following CNBC pumps and calling up a broker at Smith Barney. Such a different life from where we are today with our smartphone apps. Mark is a human who has to explain to a 10-year-old what his job is and how he does it. So that's really relatable. How he invests people's money and tries to turn it into more money. It's also maybe a default explanation of what investors want. It was interesting how he noticed his daughter's friends probably think he works in oil, maybe as a gasoline station worker in Massachusetts. I guess he is in the value chain to the far left on the shareholder board link in that chain. Mark is in Boston, where the local American football team, the New England Patriots, had a dynasty team with a mantra of #DoYourJob. You can check it out online and on the show note. Mark's new fund is a standalone strategy looking to change oil and gas companies that they own. And given his argument that the sector has, quote, a decade of value destruction and investors have generally abandoned it, unquote. A lot has changed in the few months since we taped this in Q3 of 2021. I'm now in Q1 of 2022, and the price of oil is a new 10-year high, I think. But the messages still stand, I think. Unfortunately, unlike engine number one's vote ETF, there are no plans for Kimmeridge to put out a retail offering. High point number 2 is little patience for companies not aligned with energy transition. The action of engine number one and institutional investors on the 26th of May 2021 at the ExxonMobil annual shareholders meeting, as well as earlier in that same day the Chevron meeting, and before that the legal decision in the Netherlands around Shell. They're all very significant in Mark's view. You can see my take that I did for GreenBiz called Why May 26 Matters to Companies and Investors. It's online. Mark says engine number one is not a competitor, but pulling in the same direction. He considers the involvement of BlackRock, Vanguard, State Street, et al. To have changed the game, worthy of being one of the, quote, 100 moments in the history of ESG and investment, unquote, that book project I'm working on. The power of activism is that investor has the opportunity to get the attention of the company. Aligning incentives is crucial and without tensions. That Deal podcast I mentioned at the opening led to a Twitter thread where Mr. Tom Tarosa commented, quote, Kimmeridge's Mark Viviano made some good points in our interview today. What interested me the most is the potential for increasing change of control incentives for execs if aligned with shareholders versus, say, one-time dollar payouts, or if other headway is made in sectors' executive compensation issues. Number one, reducing executive pay and aggressive consolidation push in contracting industry always felt to me like a guaranteed non-starter for oil CEOs. They're fiduciaries, but they're also humans. Tell a human to give up a company he or she built with dwindling job prospects will no doubt meet resistance, unquote. Mark's view is that the energy transition means the hydrocarbon need to change, and without properly improving ESG performance, the sector will be uninvestable. His argument is plain, quote, abandon the energy sector or fix it, unquote. And 3, the importance of humility. Like neurosurgeons, oil co CEOs and politicians, investment managers are not known for their humility. Mark identifies a key attribute for investors is humility. That surely is a differentiator to an investment hand, where egos and hubris are ordinary. His decades of experience reflects that management teams are extraordinarily skilled at telling investors what investors want to hear. I'm banking that insight. Maybe it's his early years living in Rhode Island, a fine New England state with a long coastline, sailing boats, and a legendary music festival where Bob Dylan electrified in 1964. Mark discovered his new job title when he picked up his business cards. That's the kind of colleague I prefer, just doing the job. I humbly hope, after COVID-19, to receive an invitation to sample from Mark's fine bourbon collection to relieve the stress. We can have a quiet one in the library and ponder him going all in as a hydrocarbons investor through a bad decade, and how his portfolio names can be the first to cut routine flaring and race towards net zero. And finally, the 4th high point. You can do anything with XX or XY pair of sex chromosomes. In 2022, like 2021, diversity remains a focus for investors. It is frustrating to see how things are moving so slowly on gender diversity, but things are moving. Mark is clearly not active on LinkedIn, so it was noteworthy when he liked the comment on, quote, a fantastic role model for all founders, male and female, unquote. An article on the Bumble CEO, Whitney, Wolfe, Heard, a story in the Wall Street Journal, quote, criticizes treatment of female business founders, unquote, where Ms. Heard described, "It's unfair and it's wrong. I'm pretty sick about the way a lot of these women have been completely taken out of these businesses that they've built," unquote. Read the article. Like every human, and especially anyone with daughters, we have the opportunity to flatten the obstacles to opportunities discriminating against women, as Liz Simi so powerfully noted in our previous episode, Season 1, Episode 8. In this generation, in investment land, we can be those humans that open doors and build bridges. I still hope Mark gets a shot at software and coding with his girls. I'm a fan of girls who code in similar ventures. In the bonus tape, you heard Mark talk briefly about abandoned oil wells in Colorado and who has to pay to cap them from polluting. The oil co is long gone or bankrupt. Mark argues that shutting wells probably should qualify for carbon credits, more than trees perhaps. It's a fair argument. A novelty in this episode is the question posed by my least young intern asking, quote, "When automobiles have switched to electric drivetrains, how will you explain investing in oil?" unquote. As with the whole interview, I can appreciate the point of view of Mark, in that everything from toys to food still need fossil fuels in the short term. That's also a point that Liz had made in the previous episode. But we'll change that, yes? I balance Mark's work against Garvin's, see Season 1, Episode 3, decision to never be in hydrocarbons. Mark is driving fossil fuel companies to be least bad before switching their project engineering skills to renewables. As always, if you enjoy the podcast, please post a 5-star review wherever you listen to it. DM me at ESG Architect if it was horrible. And check out at ESG and Coffee on Twitter for updates on upcoming episodes. Remember, this podcast is not investment advice. Thank you.
We hope you enjoyed the interview with one of the originals in investing, strategy, and sustainability. Please subscribe on your favorite podcasting platform or on YouTube and leave a 5-star review. Bad reviews you can send to Graham Sinclair at ESG Architect. All the details are in the show notes. And for news of our next guests, follow us on Twitter or Instagram at ESG and Coffee. Do you know an impressive human we should absolutely interview on investment, strategy, and sustainability? Please let us know on Twitter at ESG and Coffee. Our producer is Kat Farquharson on Twitter at Kat Farquharson, and original music by Aaron Bonney on Twitter at Aaron Bonney Music. And of course, this podcast is for your enlightenment, not investment advice. Do your own research.
You have been listening to the ESG and Coffee Podcast on investing, strategy, and sustainability, hosted by Graham Sinclair.